In this video, we're going to be looking at how experienced and professional traders use the structure or turning points, or what we simply call market structure, to determine direction, and how they can use those turning points to get setups that they're going to use to trade, to either buy the market or to sell the market, depending on what the structure is showing them. Right now, before we go any further, let's first take time and define what market structure is. Most of us do not understand what market structure is. Market structure is simply the turning points that you're seeing on the chart here. For example, we have this turning point, the market went up. So this is a low that the market created, and the market went up and turned from here and created this high. So when it turned from here and came down, it created this higher low here. Why is this one being called a higher low? This one is being called a higher low because this is higher than this previous low. So these turning points here, these turning points are what form market structure. Simply, that's what we call structure. Now, we go further and we learn that when these turning points are created by price, there are many things that happened inside this turning point, especially if you go to smaller time frames. I will give you an example. For example, let's just take an example of one of these turning points. Let me just mark this lower turning point here, this low here, right? Now, when a weekly time frame, when I go to the daily time frame, there are a lot of things that happen. You can clearly see here. There are very many things that happen. There are very many structures that we can see here. So the more you go to a smaller time frame, if you go lower, this is from weekly to daily. Now, when I go to H4, you'll again clearly notice that there are very many things that happened in this very place here. You can clearly see now we have a whole pattern. Those who trade using patterns, you can see that now we have a pattern in this same place here. So we're going to be looking at how you can use these turning points to determine direction, and also to get proper setups, just like how the professional traders do, how people have traded for some number of years do it, like how I do it myself week in, week out, right? So if this is the kind of information you've been looking for, do not forget to click the likes button and also to subscribe. It's your first time coming across the video. So the example I'm going to be using is gold. Of course, I use examples of things that we have broken down before so that you can learn how exactly I determined, or we came up with that decision to do that. So let's look at what actually makes the highs and lows that we have just mentioned or defined that makes up market structure. The first thing that makes up that market structure is what we call an impulse. Now, we have spoken about an impulse on this channel before. An impulse is where the market is breaking turning points without retesting them. For example, if the market breaks more than one turning point, meaning that it's breaking 2, 3, 4, 5, and the rest, right? For example, if the market is making highs and lows, let me just clear this. If the market is making highs and lows like this, at a certain point, it may make highs, lows like this. Then when it is coming down, it just breaks all of them without retesting this, without retesting this. So this becomes an impulse, right? So market movement is made up of one, impulses, right? Then secondly, a trending market, a proper trending market. But when the market is making a proper trending market, it means that it's breaking highs while retesting, breaking highs while retesting, or it's breaking lows while retesting, breaking lows while retesting those lows, right? That's the second one. Let me just take you back. The first one I've said is an impulse. The second one is a normal trending market, where the market is breaking structure while retesting the structures. And then the third one is untested levels. Now, untested levels include a lot of things that people have given different names. One of them, you can call them fair value gaps. Some people can look at them as imbalances in the market. Some people look at them as there are very many names. So these are the three aspects that are formed in that are found in these highs and lows, right? We may just look at the market that is just making it, made this high, made this low, made the higher high, higher low, like that. But in this movement here, those are the three things that have to be formed. Now, if those are the three things that are going to be formed, meaning that as a trader, you have to choose which one you're going to be dealing with. Are you going to be dealing with the impulsive moves, or are you going to be dealing with the trending markets, or are you going to be dealing with untested levels? Now, personally, I can trade all these markets here, but if you're just starting, right, you need to choose out one. And you say that I'm going to be trading only this market condition here, because all of them are part of market structure, right? But you also have to understand the rules. And fortunately enough, we have spoken about all of them. This first one, impulsive moves, whereby I use Fibonacci. Second one, a trending market, that's a continuation and trading retracements. And then also we have spoken about how we take entries using untested levels. The one I love most is trading untested levels, because those are virgin areas that the market has not touched into. So when the price comes back, that the reaction actually is going to be very massive, right? So these are the three aspects that form the market structure. You have to choose one. Are you okay? So those experienced traders are not going all over the place. That's why actually they advise that you should trade not more than two pairs at the same time, right? Have a very small watch list, and also do not trade more than two pairs at the same time. Personally, I trade one at a time. When I may have a watch list when the week is starting, but I trade one at a time. We're together. For example, those that I've been interacting with of recent, you know that I've been trading only volatility 75 from November, right? So now let's tackle one by one. For example, let's start with the trending market. Now, most people think that when you have a trending market, when it is going upwards, that when the market breaks this high, you're simply expecting it to come and retest this high like this, right? That is wrong. When the market makes a high, creates this high, comes and makes a higher low and creates a new high. So the market has a liberty to come back and retest either this point or even this low here, because this is now a high, this is a low, this is a higher high. So when the market creates a higher high on the retest has a liberty either to come and retest here, depending on the momentum. That's why I always emphasize that momentum is very key. It can either come and stop here before going up, or it has the liberty to come in between here. That's why you see people have invented things like imbalances, fair value gaps, and the rest, which are found here. Why? Because of the impulsive moves. Now, those impulsive moves, what can help you identify the possibility of where the market could come to, or another area of interest is the Fibonacci. So if there's an impulse, you're going to find there's a fair value gap, there are imbalances, and the rest, right? Or if the market can come and stop here and it pushes up, that's the second way. The third way is the market can come back down at this low here. That's how order blocks come in. That's how demand levels come in, right? So if you're going to trade and think like the professional traders or the traders who have been trading for some time, do not put in mind that actually when the market is going upwards, it is a must that has to come and stop at this high before going. You're always going to be stopped out before you can, your goal is going to be stopped out before the market moves in your direction. So what do you have to do here? Let me just show you here an example. For example, if you had marked this level here that you wanted the market to come and retest here, you can see exactly what happened. The market came, made the false breakout, and then moved in your direction. You were not wrong. The market has broken a high, so it's just coming to, we're expecting a retest, and then it give us the retest. So what do we have to do? Let me just, allow me to back test, guys. We always do breakdowns on what is on the probability of what the market is going to do. But for this lesson, allow me to just replay. So for example, if the market has broken above like this, so we know that, okay, the market has broken a high. So meaning there's a possibility of the market coming to retest. So in this case here, if the market starts turning, it means that it has created a high. And if it turns from it, means it has created this high and has created a higher high, right? But we have our low here. So it means that the market has the liberty to either come and stop here or to come and stop in between here, because this will be an impulse. Why is it an impulse? Because it has broken this turning point. It has broken this turning point and this turning point. It has broken 3 turning points, making this an impulse. So you have the liberty to either use Fibonacci, right? Remember, I've given you 3 ways. There is a trending market. Now, in this case, we have 2 confluences. We have a market that is having an impulse, and also it has broken a high. So this is a high, a low, then a higher high, right? Why is it a higher high? Because it has broken this high. So you have a trending market, right? That is 1. And 2, you have an impulsive market, right? So we can just wait and see if the market brings in an opposite candle, for example, a red. Now you can choose to bring your Fibonacci. So I'm just going to mark like this, and then I bring my Fibonacci, then I mark my area of interest to be as this one here. So this can be an area of that the market has left behind, right? Now, the market can either come and stop here or it can come and stop here. That's one thing that you have to keep in mind. The third point is the market can actually come back to where it started from it can come back to this support here. So as long as the market does not take out this area here, it means that the market is still an uptrend. Are we together? This is how you should look at structure. The people who have been trading for very many years, for them, their interest is to just identify where possibly can the market turn from. For example, the market can come and turn from here, it goes up. Or if the market can come and turn from here, then it goes up. Or the market can even come back to this low here, and then it goes up. Now, what will separate you from knowing that the market is turning from here or it's turning? Let me just change the color. What will make you know that the market is turning from here to go up, or it's turning from here to go up, or it's turning from here, is the momentum with which the market is retesting with, the approach with which it's coming to this level here, and the change of trend. Are we together? What now? Let's go into that. I've spoken about it in one of the previous videos, but let's just go about it briefly into it because we're speaking about structure. Now, how do you know the market is changing trend? For example, if the market is coming down to retest, it means that you'll be making lower lows and lower highs. The market, you'll know that it's going to change when the market breaks a lower high to start trending upwards. That's when you know that the market now is ready to start pushing higher. Are we together? So after tapping into this area and you see this happening, then you know that now I'm ready to start buying. If that does not happen here, and continues low, it means that now my next area of interest is this one here, meaning I'm interested in looking for this into this area here. Are we together? That is how experienced traders look at the structure. They do not look at structure and say that it must buy from here. This is the area the market is going to buy from. No. If the market does that, just identify the probabilities where probably the market could turn from. And in this case, we have identified 1, 2, 3. How have we determined that? Now, the first type of traders are going to look at it from here. The second type of traders who are looking at the impulse are going to be looking at this area here. The third type of people are looking at demand and the order blocks and the rest are going to be looking at this area here. You're getting it? So this all sums up what structure is. What is going to differentiate you from being in the majority, and the minority will be consistent over time, is how you understand this. Are we together? Just understand that market structure has 3 aspects in it: impulses, a trending market, and untested levels. Are you getting it? So let me just repeat that again because it's very key. 1 is impulses. Impulses is this impulsive move here, aggressive, where the market is breaking more than one turning point. Then secondly, a trending market, where the market is either making higher highs or the market is making lower lows and lower highs. Are you getting it? Then thirdly, untested levels. For example, this area here is untested. Also, we have this area which is aligning with this fib area here as being untested. So the market can either come back to this untested level, or it can come back down to this demand level here, or what you guys may determine as the last candle that pushed out the market, which will be like an order block. The term you give it does not matter, but I just want you to understand it, because all this forms structure. Any type of market movement is going to have at least one of these 3. It will even be best when it has 2. For example, this one of ours has 2. The market has broken this structure, and also it has this impulse upwards. So meaning that there are higher probabilities that the market actually may not come back down here. So meaning I'm going to be focusing into either this area or this area here. So let's check exactly where the market stopped. I see the market came, and what happened? It came, and because this is the current price, sorry, the market came and tapped into this box of ours and then pushed higher. Why? Because we do have a market that gave us a break of this structure, this high here, and then we had an impulse. So the high probability area for the market to come back to will be this area here before the market going higher. You're getting it? So the difference is going to be that how are you going to treat this movement back down here is how the market changes trend, like how I've explained to you. If the market, let's just go back slightly. Let's just go back slightly and I show you exactly what I'm meaning. So if the market touches this area of interest of yours, then you go to your entry time frame, which is H4. Now, when you come down to H4, you're going to observe that the market actually is also trending. It's making lower lows, lower highs, lower lows, lower highs, lower lows. So in this case here, the market has already tested this low. Let me just change the color to green. It has already tested this low, meaning that here in this case, our lower high is this one here. So for us to take an entry, the market has first break here. But if the market comes and reacts to this green level, it means that this is now our lower high, and then we can take a trade from there. Right, together you can see the market came, so it has reacted there, right? So if the market closes above now, then we can take our trade. You can see it came, reacted to this area here, this previous low here. Let me just mark it for you here. This previous low area, it reacted here. So when it closes above this point, you know that now you can take your trade high, right? So you can see from here, the market is now bullish, right? This is how you should look at the market. This is how exactly people are experienced. The traders who have been trading for some time look at the market. They do not look at the market by guessing or forcing that the market must come back to this point here, the market must do ABCD. Are you together? So I really hope you can utilize it. Have a great day.